High yield is a bit more complicated. I mean, if we look at the releveraging trends, if we look at all the covenants that have been taken out of the prospectus for bondholders, all that protection is going away, and the spread has been really very, very low. So that is a bit kind of worrying.
Well, Annie and Eric, welcome back to the TV studios. It's a pleasure to have you both back.
Thank you, Jessica.
Thank you.
So today we're looking at the US yield curve. Now, Annie, what do you have to say about these movements?
Yeah, I think everyone is talking about the US yield curve. It has been flattening massively since the beginning of the year. I mean, the spread between the 10-year and the 2-year has dramatically flattened. It means that the differential between 10-year and 2-year has been completely shrunk from 130 basis points at the beginning of this year to currently 60 basis points. That might be worrying. My personal interpretation is I think either the market is too complacent about inflation expectation and inflation going forward, meaning that investors are very complacent, and that the thing is that if we are wrong, if we have pass-through effects from oil prices and things like that, and we have a spike in inflation, it means that we have higher rates, which ultimately is negative for credit, but we will talk about this later. And my second interpretation is that maybe the markets see that the cumulative Fed tightening is a bit too much, and that we will have a slower growth next year, a slower growth with an inverted yield curve, meaning a recession. And that also is negative for credit because it means that we will have a higher default rate. So either ways, it's quite worrying next year what will happen. And this major move of the curve is something we have to look at.
Absolutely. And Eric, what do you think about the flattening of the US curve?
Yeah.
What do you think it means?
The flattening of the curve is can be worrying because everybody knows the consequences of a flat curve. But to be honest, I'm a bit reluctant to comment the consequences of a flatter curve, because historical comparison is a bit dangerous, because historical comparison means that all things are the same. And in the past, we didn't have any QE, we didn't have any negative rates in Europe, and so on and so forth. So it's a bit difficult to say, in the past, a flatter curve meant this thing and this thing, and now it will be the same in the future. Nobody knows. Having said that, it is true that I was in favor of the flattening, so I'm really happy. And I think that it will continue. Now the curve is relatively flat. And as Annie said, I think it will continue, but the most dangerous signal is not a flatter curve, is an inversion of the curve, especially the inversion between the 10-year and 30-year. And today, 30-year yield is around 2.75%. It's amazing when you think that the Fed funds will increase next month, and the curve is very flat. So for me, it's a kind of a fair warning for 2018. It's not dangerous, but should things start to go worse in the risky markets, and when I say in risky markets, I include equities and high yield, it would be the beginning of the coming back of the US Treasuries.
And now jumping ahead to 2018, so what can investors expect from credit markets in 2018? Annie, let's start with you.
Yeah, Jessica. As I said before, I think either ways it's a bit complicated. In a way, in the US, if we have the fiscal package going through next year, it can mitigate some of the negative effect of, let's say, if we have higher rates and we have a correction of that movement. So that we can say that it can mitigate in a way. But again, the cushion, it means the premium of spread we have is very, very thin today. So it really depends on what movement on the yield we have. Now, the fiscal package would help, I would say, mainly investment grade bonds. So we're not that negative, I would say, on that type of bonds. High yield is a bit more complicated. I mean, if we look at the releveraging trends, if we look at all the covenants that have been taken out of the prospectus for bondholders, all that protection is going away, and the spread has been really very, very low. So that is a bit kind of worrying. Now, in terms of European market, also we have two central banks shifting their policy. Okay, US will be shrinking its balance sheet, and the ECB will be reducing quite massively its purchases, in the sense that instead of buying 60 billion per month, they will be only buying 30 billion. But on another hand, you've got 50 billion reinvestment. So it must have a kind of impact on credit, a kind of repricing. Now, again, what can mitigate that negative, I would say, is that we know from Mr. Draghi, who's leaving, I think, in November 2019, that he will be quite reluctant first to raise the rates before he finishes its purchase program, and maybe before he leaves, he might do something. But we have plenty of time to see that. But again, we're not that positive on credit markets right now. We think that we will have a correction, and we will be more, I would say, positive when we have a kind of correction to be again in the market. We prefer cash right now, I would say.
Fantastic. And Eric, are your thoughts quite in line with Annie's?
Totally in line regarding the US market. In Europe, I am more confident. I think that the ECB will be very careful, and that the purchases will continue, and even if the amounts are lower, the impact will not be significant on the investment grade market. The more dangerous asset class is, in my opinion, the European high yield market, because spreads are very tight, the market is small and very volatile, and we saw two weeks ago a beginning of a sell-off, and this is the most dangerous asset class in the credit universe.
Even worse than emerging markets?
Probably, yes, because emerging markets, if you bet on the best in class, such as India, for example, which has been upgraded by the rating agency, emerging market spreads are very stable, and the most important in this market is the carry now. You cannot expect huge profits due to the tightening of the spread, but you have the carry every day. You have a higher coupon and higher yields in this very low yield environment, and globally this low yield environment will persist next year, even if yields could be a little bit higher. Yields are so low now that they will stay low even if they are a bit higher.
I will say that just to conclude, the big team next year will be back to quality, I think.
Yes.
Fantastic. Well, both, thank you so much for coming in today and sharing your insights. As always, it's a pleasure. Well, that's all from us here in the Geneva studios, but we want to hear how you found this interview, so please do like and comment on Dukascopy.tv.